Hey guys, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. And this is part of an ongoing series, a video series that we started maybe a month or so ago. And what we're trying to do with these videos is we're trying to complement the Undervalued Dividend Growth Stock of the Week articles. So that's a long-running series we've been doing for a few years now, where once a week on Sunday I highlight a high-quality dividend growth stock that's culled from David Fish's Dividend Champions, Contenders, and Challengers list. I cull from that list and I look at stocks that I think look appealing on a valuation basis. You know, first of all, looking at the fundamentals and making sure it's a high-quality business, making sure that there are competitive advantages, you know, they're durable competitive advantages, and some, you know, business that, you know, I understand coming from an investor and a writer point of view. And then once I have a stock that I think I can present, I want to make sure that the valuation is appealing. And then I go through all the fundamentals, I go through the valuation and present an idea every Sunday. So we've been doing that series for a long time now. We started the video series maybe a month or two ago, where again we're trying to complement those articles whereby we're, you know, breaking down everything, we're going through the numbers, breaking everything down, and that way you can see, once you kind of distill all of the numbers down, you can see where the conclusion came from at the end, to see where the valuation came from, see where all the numbers are coming from, and then when we put everything together, we think that it adds value to the series. So we've been doing these for a few weeks now, so we're doing another one here today. And of course, the Undervalued Dividend Growth Stock of the Week articles, you can see when you go to Daily Trade Alert, you're under the Dividend Growth Investing heading there, you click on the Undervalued Dividend Growth Stock of the Week tab, and then you can see all of the articles that I've written over the last few years. And then you can also see the video analyses here. You can see an individual video analysis there for Grainger, for CVS, Disney, and Magna. And today we're doing another one. This one's going to be on SBUX, which was an article that was published on August 6th. And of course, when you click on that, it'll go over to the article, which I've already clicked on. And this is the article here. So, and again, kind of going back through where I come from with these articles, I start off each article with a big idea. You know, why we should be looking at these stocks, why we should be interested in dividend growth investing as an investment strategy for the long term. Where's the buy-in? What's the value? You know, what are we getting into? And so each article starts out with that big idea. Why you readers should be interested in this, how it can positively change your life, because it positively changed my life. I talk about this all the time. I was below broke not too long ago, just a few years ago, and by saving and investing my money in these really wonderful businesses that reward me with growing dividend income, I've been able to supplant my job income with that dividend income and basically live as I please. I've become financially independent, and I try to extol the virtues of this through my writing, because I really believe that it's incredible stuff. And I try to inspire you readers by just sharing what's happened to me and then showing you each individual opportunity each week and how that can lead to long-term really good results in terms of total return, in terms of growing dividend income and everything else. So I started off SBUX talking about each day being an opportunity, and you know, we're never younger than we are at this moment. So at this moment, it's August 9th, it's almost 6 o'clock in the evening. I'm never going to be younger than I am right now, because in an hour from now I'm going to be older, and that just continues so on and so forth as we grow and as we age. So you got to think about that. Every minute is an opportunity to better yourself, become wiser, become wealthier, become smarter, become faster, become stronger. And when you break down those individual moments into almost seconds of opportunity and you add them up in aggregate, then every single day is just a massive opportunity, because it's filled with all these individual opportunities that add up to huge life-changing moments if you take advantage of them over and over and over again. That's kind of what investing is. It's saving, routinely investing, putting your money away, and just adding up those stocks, adding up those shares, adding up those dividends, letting compounding work for you, and it just continues to snowball over time. That's what it is. You're taking little individual opportunities and adding them up, and over time they become very, very large. So getting into SBUX a little bit, what SBUX is, it's a business that with each stock that I go over, I want to talk about the business, what the business does, its story, how it makes money. SBUX I really don't need to do that too much with, because you know, it's on, I think we just here, I'm in Sarasota, which is not a terribly large city, and I have a couple Starbucks almost within walking distance from where I'm at here right now. So they're a very large business. They've got over 24,000 stores across the globe with plenty of room to continue to increase that footprint, but they're pretty much everywhere, which is a good thing and a bad thing. I mean, it limits some growth opportunities down the road in terms of expanding that footprint in already developed areas, but it's also an opportunity because people are familiar with it. It's a great brand. People love going to Starbucks and hanging out there for hours and drinking the products. I actually typically write, I do these videos at home, but I write my articles, all these articles that I write, I typically write them from a Starbucks, actually, one very close to home. And I'm in there for maybe 3 to 4 hours per visit, and I do see a revolving door of people coming in, coming out, getting their coffee and leaving, or they have a drive-through too, so people drive through and get their coffee and leave. But what I also see is I see regulars come in there and just hanging out for hours. They'll drink their coffee, they hang out, they a lot of people have meetings. Actually, I see real estate agents come in there all the time with clients come in there. They'll grab 3 or 4 coffees. They'll sit there and talk for an hour, go over paperwork, go over comps and whatnot. I'll see students come in there and study and drink the coffees. So it's not just a product, it's an experience. And very few companies can manage both of those that well, where they offer a high quality experience that people want to pay a premium for, and then a high quality product that people want to pay a premium for. But that's what Starbucks does. It's a brand name that conveys not just high quality coffee, but also a high quality meeting place where you also drink that coffee. And that's something that Starbucks does better than anybody else, and that's why they have 24,000 stores across the globe. Getting into the business a little bit, and before I do that, I just want to talk about that store count real quick. So I've got the 2016 annual report pulled up here, and I wanted to go back to that page. I scrolled through already to the financials, but let me, I think it was around page 24 here. Let me see where we're at here. I think I scrolled too far. I want to talk a little bit, guys, about the number of stores outstanding and kind of what I think is a massive opportunity moving forward. A lot of, yeah, here we go. So this is the page I wanted to go to, which we're on page, for the 2016 annual report, we're on page 21 here if you're following along when we do these videos. The most recent quarterly report came out, and there's some concerns over, you know, comp sales slowing because of store cannibalization. What that means is as Starbucks opens more stores, it limits comp store growth per store because each new store brings about customers that are no longer perhaps shopping at the old stores. So when you're growing your footprint out like that, one of the I mean, it's a huge opportunity because it's a new store and you're selling new products, new experiences, but at the same time, you are perhaps, if that store is too close to an existing store, cannibalizing off of the existing store sales. So you're increasing your expenses for perhaps not the same gain in terms of sales and profits. And you got to be careful managing that as you become a global behemoth like Starbucks has become, where you walk that fine line between, you want to experience absolute growth, but you also want to keep the relative growth pretty strong too. But what I want to talk about real quick here is they actually break their store count down here, right? So you've got 25,000 stores here total, company owned, licensed, they break it down across the board. And the Americas right here, right? We've got over 15,000 stores across the Americas, company operated and licensed. And when you think about the Americas, the Americas relative, well, United States is their biggest market, and we have what, 300 and, I don't know off the top of my head, 350 million people maybe in the United States where they have this many stores, and there is a saturation there occurring, certainly, especially in larger markets like California. I think California is their number one market in the United States, if I'm not mistaken off the top of my head. I've read through this stuff a lot, and I digest it, but I can't always recall all the facts and figures off the top of my head. But I believe California is their number one market here in the United States, which isn't a surprise based on the population. But you know, we're talking what, you know, over 15,000 stores in the Americas. But look at China, Asia Pacific here, of which China is obviously the largest country out there. You're looking at what, under 7,000 stores total. You know, that's a major difference. And China alone has what, over 1.3 billion people. And I have this press release open here, and this was something I wrote about in the article. I kind of highlighted their growth opportunity in China, especially relating to this recent announcement where they're going to assume 100% ownership of its stores in China. They're going to own and operate their stores on mainland China. And right here, company reaffirms its commitment to operating 5,000 stores in mainland China by 2021 in this press release here, which was dated July 27th. You know, 5,000 stores for 1.3 billion people. Keep that in mind. 5,000 stores for 1.3 billion people. And that's by 2021. What that tells me is you've got a humongous, I mean an extremely long runway for growth, looking out over 20, 30, 40, 50, 60 years. Because if we're talking 5,000 stores by 2021, that isn't even beginning to scratch the surface in terms of the potential for Starbucks stores in mainland China, looking out over the long haul. And by 2021, China's going to have far more people than they have today, right? They haven't even caught up to that point yet. So we're looking at a multi-decade run of not just comp growth, but absolute growth as well in terms of the overall footprint of their stores. So when their quarterly report came, I actually started writing this article. This article was published on August 6th, but I started writing the report at the end of July. And so there's, as I've talked about in prior videos, there's a delay sometimes. I start writing an article a week or so before it's published, or even sometimes a couple weeks before it's published. It's published, and then I do the video maybe a week or two or three after the article's published. So there's sometimes a month or so of gap or delay between when I compile these numbers and when this video comes out. So keep that in mind. And they recently reported a quarterly report, of which this press release was kind of attached to that. I think this is incredible news. To own and operate their stores on mainland China is going to be humongous over the long haul. There is some saturation here. Comp growth is still pretty strong though, all in all. I mean, there's been some slowdown there, but the numbers are still pretty strong when you look through the quarterly reports. But China is just huge. I mean, you look at the Americas here, and then you compare that to China, Asia Pacific, which is really where, you know, all the growth and all the people are going to be moving forward. That's just humongous. So getting into the dividend, of course, the next part I get into with the article after I talk a little bit about what the company does, how it makes money, what its story is. And I talked about a little bit about the best of both worlds here, which is, again, that high quality experience and that high quality product. They're mirroring the two together, and each one complements each other. They're inextricably linked together, and that's what Starbucks does. So the next thing I get into is the dividend, which I pull all the information from David Fish's Dividend Champions, Contenders, and Challengers list, which I'm going to open up in a new link here. And whenever you're looking at an individual stock, you can of course peruse his list. It has over 800 different US listed stocks on it. But if you're looking for a specific stock, you just go ahead and pull, find the stock ticker there, which you got right here. And then you see all Starbucks dividend information here. You see consecutive years of dividend growth. You see the yield, which David updates this list once a month. So obviously the yield will change over the course of a month based on the price action. You've got the most recent dividend increase, and then you have your longer term increases here. And I've talked about this a little bit in the videos before, that I look for either acceleration or deceleration in the dividend growth. If there's an acceleration off of, say, a lower number, like let's say the 10-year dividend growth rate is 8%, but then the 5-year is maybe 11, 3 years 12, and the most recent increase was 13 or 14, there's clearly an acceleration point there. What happens, however, with a lot of mature companies, you'll see a deceleration. You'll see a higher dividend growth rate, maybe double-digit dividend growth over the last 10 years, say of 15 or 16%, but then the most recent dividend increase might only be 6 or 7. That's a clear deceleration. As a company matures, as its payout ratio expands, it limits the potential for outsized dividend growth above and over what earnings per share growth is. So you just got to keep that in mind. But what we see here with Starbucks is there is no deceleration. Their 5-year dividend growth rate is 25%, right? Their most recent increase was 25%. That said, I would strongly expect, and I would strongly advise you that if the next dividend increase is below 25%, to not be surprised, because their payout ratio has crept up a little bit. It's basically at what I consider a perfect harmony between retaining earnings for the company and paying out profit to shareholders in the form of a dividend, because their payout ratio is pretty close to 50% here, which is a TTM payout ratio, and I noted that in the article. Let me get back to that, speaking of which. Let me get back to the article here. So I've got the 7 consecutive years of dividend growth, and you see that on the list right here, 7 years. And then we've got the 5-year dividend growth rate at 24.9%, which again rounded up is 25%, which is really incredible. But that payout ratio, again, we have it at I have it at 50.8%. The numbers that I came up with might have came right around the time they released earnings, and where I get that from, you're looking at Google Finance here, EPS, which is trailing 12-month EPS, TTM EPS, and then you divide the dividend by that TTM EPS, which the dividend is $1 annually divided by $1.97. You get a payout ratio of we'll call it 50.8%, which I have right here. I just rounded that up. And I noted that I think that payout ratio is pretty close to perfect, because Starbucks is essentially retaining half of its earnings to grow the business, to fund M&A and fund new stores and fund acquisitions, to fund new products, R&D, and then they're sending out the other half to shareholders in the form of that dividend. So it's a really, really great balance between the two. However, that said, their payout ratio was lower prior to that dividend institution in 2010, and then the subsequent growth thereafter. You can see in Morningstar here, when you look under the key ratios, you see the payout ratio here when they first started, under 20%, and then it's kind of expanded ever since. Their earnings per share, they had some adjustments in here which affected this payout ratio, especially right here, 319%. That's not accurate. But you see a steady increase in that payout ratio, and that's why I'm saying that 25% dividend growth is not going to continue much longer. You know, the dividend growth is probably going to roughly match earnings per share growth, at least over the near term, assuming that they don't continue to expand that payout ratio, which I don't think they will. I think 50% or so for Starbucks is a pretty solid number to look at. But again, that said, also, as we'll get into a little bit later, the earnings per share growth demonstrated over the last 10 years and then moving forward is very, very strong, well into the double digits, which could certainly support double-digit dividend growth. So I wouldn't expect much of a slowdown. I mean, I'm not saying, you know, I don't think I'd expect 25% dividend growth over the next 3 to 5 years, but I also wouldn't expect 10% dividend growth. I mean, you know, 15 to 20% or something in that range seems to be really, really reasonable. And then I model in a much lower, very long-term dividend growth rate as we talk about later in the video as we go on throughout the article. So we've got the 7 consecutive years. We've got the 5-year dividend growth rate. We've got the payout ratio. The one really knock against Starbucks stock, depending on where you're at as an investor, depending on your age and your income needs, is the yield. The stock is yielding 1.86%, which is a little higher than when I wrote the article, so that means the stock's probably gone down just a little bit. You know, that's not a great number to look at if you're an older investor. If I were, you know, 20 or 30 years older than I am right now, I'm 35, but if I were 55 years old, would Starbucks be interesting to me as an investor, as a long-term investor? Not so much, because I'm thinking about current income. I'm thinking about how do I pay my bills right now, today. I'm not thinking about dividend growth over 10 or 20 years. I'm thinking about right now. But I'm 35 years old, so I can afford to have higher yielding stocks in my portfolio, like your utilities and your telecoms, balanced out by those lower yielding stocks with higher growth rates, like a Starbucks, like a Visa, you know, even like a Nike, something like that, where you're sacrificing some current income and some yield in exchange for that higher growth rate. Because I'm thinking about not just the Jason of 2017, I'm thinking about the Jason of 2027, of 2037, 2047, keeping my fingers crossed that I don't get hit by a bus or something as I cross the street. So I'm trying to balance those two. So it really depends on where you're at as an investor. Not every investor will be looking at Starbucks. If you're 20, 25, 30, 35, even maybe 40, 45 years old, this is a very, very compelling long-term investment. Not just in terms of the dividend growth and the overall aggregate income, but in terms of total return, because it's already been an outstanding investment over the long haul, and I don't see any reason why that won't continue when looking at their opportunities across the world. And again, just highlighting valuation, as we'll continue to talk about, and this will be a theme as we go throughout the video here and as we talk about in the article, their current yield, although somewhat relatively low compared to the broader market and compared to a lot of other dividend growth stocks at 1.86%, it is much higher than the 5-year average. So investors over the last 5 years have been willing to accept, on average, a yield of 1.3%. You can see right here under the valuation tab for Morningstar, their 5-year average yield at 1.3% compared to where it's at right now, 1.8%, actually getting close to 1.9 now. That's a spread of over 50 basis points, guys. So what investors have been looking at accepting before is much lower than what they're looking at accepting today. Is Starbucks a lower quality company than it was 10 years or over the last 5 years on average? No. Are there opportunities any less than what they have been on average over the last 5 years? I personally don't think so. They have a larger store count, sure, which might affect those comps, but it's also more revenue and more profit, right, in absolute terms. When looking at that kind of spread, almost 60 basis points now, that's pretty significant in a higher growth stock like this. And I think that's a pretty solid opportunity. Generally, when you've got a disconnect between current yield and average yield over the last 5 years, if the current yield is much higher than what it's typically been on average over its recent historical average, that usually indicates an opportunity in terms of valuation. Likewise, if this yield were, say, 0.8% and usually average 1.3, then that would indicate that the stock's run up and that there's probably an overvaluation occurring at that time. But that's not what we have right here. We have it the opposite case, and we'll talk a little bit about that as we go throughout the article. So I showed the yield right there at 1.8% when I wrote the article. I talked a little bit about how that's 50 basis points higher than its 5-year average, which ties into the undervaluation thesis as I discussed above, which if you scroll up and as you read through these articles, I talk a little bit about why undervaluation is so attractive to the long-term dividend growth investor, and that's 3 primary reasons, which is higher yield, greater long-term total return potential, and less risk. And then I talk about how that works out, how that plays out in real life when you invest in these stocks, when you buy these stocks. So those are the dividend metrics. Overall, very strong. Double-digit dividend growth. They have 7 years of dividend increases, which isn't really a knock against the stock because that's because they instituted a dividend not too long ago as they started to mature. So it's really not a knock against the company. And looking forward, as we'll kind of get into here, I would expect very strong dividend growth to continue well into the double digits for the near term, and even flattening out over the long term, still very, very strong when looking out over 10, 20, 30 years. The next thing we get into, of course, with these articles is the underlying growth. I look at top line and bottom line growth, revenue growth, profit growth, earnings per share growth, diluted EPS growth, and then I compare that to a near-term forecast looking out over the next 3 years from CFRA, which is a professional stock analysis firm that they employ professional analysts to look at these stocks and come up with the conclusions and forecast things out based on recent guidance, based on recent historical growth, so on and so forth. So when I look at a fairly mature company, which Starbucks would qualify, if we want to look at the market cap, this is a $77 billion company. It's certainly large cap. And for what's primarily a coffee shop, I mean, you got to think about that. This is a coffee shop, and it's worth $77 billion. So yes, I would classify them as mature with the qualifier, keeping in mind within the context of their overall store count in very large markets. They are mature in terms of market cap, and especially in terms of the business model, but the growth opportunities are still outstanding. So mature company, but they will continue to mature and become even bigger than they are right now. I can almost guarantee that. Getting back to my initial point though, when I look at mature companies and looking at revenue growth, I'm usually looking at mid-single digit revenue growth, 4 to 6, 7%, somewhere in that range for a lot of the companies I look at. For a lot of the more mature, stable companies where I like to see a strong wherewithal for the dividend, a strong commitment, strong fundamentals to support reliable dividend income and reliable dividend income growth. Starbucks exceeds that, which shouldn't be a total surprise, because although they are a $77 billion company today, they weren't 10 years ago, and they have been aggressively growing their store count and aggressively growing the numbers. So that's not a huge surprise. If anything, it's a great number. It's a great upside to what you might expect with a more mature company. That's actually double what I would usually look for in revenue growth, and that's where I got these numbers from. I'll show you. So we've got total revenue here. We've got total net revenues. This is the 2007 annual report. You see here their fiscal year ends on September 30th of each year. So third quarter, I should say. So we've got total net revenue, $9.411 billion, which I reflected in the article, $9.411 billion. And then I'm going to scroll down to the financials on the most recent 2016 annual report, because we were looking at that store count. I just wanted to make a kind of a point on the growth potential there in a country with 1.3 billion people, which is incredible. I'm going to scroll down to the financials here. Okay. So we've got total net revenue right here for the most recent fiscal year 2016, $21.315 billion. 21.316 billion. I'm sorry, I rounded that up. You see the 0.9 right here, guys. 21.3159, rounded that up to 21.316. And as I've talked about before, Morningstar is usually pretty accurate with these numbers. If you want to take a quick check on a stock, or if you want to, if you don't want to pull up annual reports, pull up quarterly reports, 10Ks, 10Qs, and press releases, if you just want to say, just a quick idea of maybe what something's doing, what's the growth, what's the valuation like, you know, that valuation tab is really nice to compare current valuation to recent historical valuation across sales, earnings, cash flow, yield. You can also look at the revenue, earnings per share growth. You see 94.11 and 21.316. 94.11, 21.316, so they're accurate there from the last 10 fiscal years, 2007 to 2016. And then to get the growth rate, you just punch that into a compound annual growth rate calculator, which, again, as I've talked about in prior videos, I use Investopedia's CAGR calculator, but you're free to use whatever one you want. They all work the same. So we've got two numbers, 94.11. Then we got 21.316. And we're looking at 9 compounding periods. Although it's a 10-year chart, we're looking at 10 fiscal years. The first fiscal year is a starting point. It's not a growth period. So we've got 9.51% for the compound annual growth rate. You can see that reflected right there. And I talked about how that's a pretty strong revenue growth rate for what's really essentially a mature company. And then we're looking at earnings per share growth, which is really the more important number. I mean, if revenues are somewhat flat, but earnings per share, you know, you can see that compounding growth rate in mid-single or high single digits due to either a margin expansion or some type of accretive M&A, share buybacks, what have you. That can also be very solid. And I see that a lot with insurance companies, actually. A lot of insurance companies over the last decade have had trouble growing revenue, but earnings per share growth is still very strong, which can support, like dividend growth, almost indefinitely, assuming they don't eventually buy all their shares back and, you know, there's nobody left to own the company and they go private or something. That can support that for a pretty long time. I mean, you eventually want to see some revenue growth, but if revenue growth is flat and you're seeing earnings per share growth, there's excess bottom line growth based on any number of individual factors I just laid out, then that can certainly support dividend growth for quite a while. So we've got 44 cents and $1.90. Those are the comparative numbers here when we're looking at the two annual reports, 2007 and 2016. And you see diluted earnings per share, you see 87 cents. The reason why I cut that in half, well, I rounded up, cut it in half and then rounded up, is because they had a stock split. You can see the diluted outstanding shares here, 770,000. And then you see here, and these are in millions actually, guys. Sorry, I didn't word that right. But you see the number double, and that's because they had a 2-for-1 stock split. When you see shares double like that, you're gonna wonder what's going on. And you see the 2-for-1 stock split here on Google Finance back in 2015. That's what affects the numbers. So when you're looking at these numbers on a per share basis, not in absolute numbers, but in relative numbers compared to the shares outstanding, you gotta cut everything in half due to the 2-for-1 stock split. So I basically took that number, that 87 cents divided by 2. 43.5, I just rounded up to keep things pretty comparative when I do these articles. I just rounded the closest number. So again, we've got that number at 44 cents, and then the most recent is $1.90, which you see right here. Earnings per share diluted 190. So we take those two numbers. And we get a compound annual growth rate of 17.65%, which I reflected right here. Really strong bottom line growth. And you see obviously quite a bit of excess bottom line growth compared to the top line. I mean, even if they would have came in at 11 or 12%, pretty close to that top line number, that'd still be very impressive. But when they're coming in at almost 18%, that's pretty extraordinary. That's remarkable. And you know, you can look at, kind of say, well, where did all this bottom line excess growth come from? And like I said earlier, you know, generally you're looking at accretive M&A, you're looking at share buybacks or increasing profitability, some type of margin expansion or something like that. And you can see their shares laid out right here. There's been a minor reduction in shares outstanding, nothing really to write home about. I mean, they've been actually pretty steady over time. But what you really see is you see some margin expansion here. You see their net margin over the prior 5-year period right here, guys. You see right down here in the upper single digits, and then you see here we're getting in low and mid double digits. You see definitely a margin expansion there, and that's just Starbucks doing what Starbucks does. if you compare what Starbucks charges for a latte compared to not only what it costs, but compared to what maybe someone else will charge for that, it's incredible what they're able to get for these coffees. And I'm a customer. I look at my coffee shop visit to Starbucks as an investment because I'm able to go there and I'm able to concentrate on my writing and do a lot of things with that, and I'm able to work online versus being home and being kind of distracted by everything going on here. But for most people, I mean, if they're getting a latte or two a day or something like that before work or maybe after work, that's just an incredible amount of money they're spending on these coffees. And props to Starbucks for being able to charge, you know, for a large latte or whatever, you know, $5 or $6. It's really incredible, and you see that margin expansion playing out down here. I mean, again, we're talking upper single digits, and then now we're seeing lower to mid double digits over here. Definitely an expansion in the margins, and I lay that case out in the article about how that's pretty extraordinary for them to be able to do that. And are they going to be able to continue to do that? You know, probably not much of a margin expansion moving forward. Again, I think it's going to be more just absolute growth in terms of store count and maybe some comps in those faster expanding markets. That said, one of the things I look at in these articles is forward-looking growth in the bottom line. And CFRA, they do a 3-year projected earnings per share compounding annual growth rate, what they think the company will do over the next 3 years. And they've pegged that at 18%, which again is pretty much what we see, what Starbucks has demonstrated, what they've done over the last 10 years. So we're talking pretty much a status quo here, and their case is made out. CFRA makes their case based on global expansion, which I talk about here, how it's still a massive opportunity because they do have a lot of stores, you know, well over 20,000 stores, but a lot of them are concentrated in more developed and more mature markets. Where their growth is going to be going forward is definitely going to be international, and that's why they're making that aggressive move in China, which I think is fantastic. I think it's going to really work out for them over the long haul. And you can see right here, I talked about this. Comparable store sales in China were up 7%, which is far in excess of their global average. So their fastest growing market in terms of the potential for store count is also their fastest growing market in terms of comps. So it's both absolute and relative growth. That's where all of their opportunity is over in Asia. And it's still just, I mean, they're in the first inning for that kind of growth, and that's why I think CFRA laid out 18%. Basically, what CFRA is saying is they've grown at 18%. We think they're going to continue that. We see no reason why there's going to be a market slowdown between what they were able to do and what they're probably going to do moving forward. It's just keeping that number just where it is. You see that line go at 18%, and we're just saying that's going to continue moving forward. And I see no reason really to doubt that moving forward. Again, their developed markets are slowing down in terms of comps and everything. Keeping in mind still that there's still room for store expansion. I was just reading an article not too long ago about Starbucks, about how some of their biggest markets, like in California, they average something like, wherever you see a Starbucks, there's 2 others within a mile radius. So right, yes, that is an issue in those more mature developed markets. But even within the United States, there's areas in the middle of the country where you can maybe go miles without seeing a Starbucks. So you kind of keep that in mind when you see these articles, and oh, for every mile there's 3 Starbucks. Yes, sure, in just certain markets, in just certain countries. That's certainly not the case globally, and that's certainly not the case even within those markets when you start to pull things out and look at, you know, from 5,000 feet out. So the growth potential is really strong. They've been growing at 18%. A professional analysis firm thinks they're going to continue growing at that rate. Will they continue? Even if they slow down a little bit, even if they come in over the next 3 years at 15%, that would not be a disappointment. That would still be very, very strong growth for what's a $77 billion company. I would not blink an eye at that at all. The next thing we get into is the rest of the fundamentals. And before I move on to that, I just talked a little bit about that East China joint venture, allowing the company to operate all Starbucks stores in mainland China. It's the largest single acquisition in company history. And that's why I think that growth rate is going to continue. And I lay that case out a little bit before we get into the rest of the fundamentals. So moving on, I talk about the balance sheet next, which I get into the long-term debt to equity ratio and the interest coverage ratio. And this is the 2016 annual report. So getting into long-term debt to equity, we're looking at long-term debt. And I'm going to just spoil the surprise here. The balance sheet's fantastic. A lot of bigger, more mature companies over the last decade have loaded up their balance sheet with cheap debt to do a number of things. You'll see a lot of strong buybacks over the last 10 years accelerated off of perhaps any other point in history for some of these companies. I mean, there's been a lot of companies buying back a lot of stock. So when you have cheap debt in exchange for more expensive equity, that's generally a good move over the long haul. But at the same time, it does deteriorate that balance sheet moving forward. And unless they start to get rid of that debt before interest rates rise, depending on the terms and everything, and the revolver and everything else going on with the debt and the balance sheet, that can start to deteriorate that company moving forward. Starbucks, on the other hand, all this growth, this 18% compound annual growth rate with their earnings per share, has been funded basically with almost no debt. I mean, the balance sheet is still pristine. And just to kind of get into that, the long-term debt to equity ratio, we got 3202. We've got shareholder equity down here, 5884. So we got a long-term debt to equity ratio of 0.54, which I reflect right here. And as I've talked about in prior videos, the long-term debt to equity ratio, I don't really, although it's a bellwether metric and a lot of people use it and it's bandied about all the time, I don't really look at that number too much, because although long-term debt in absolute and relative terms is important to keep in mind, the shareholder equity portion of that equation can be massaged and it can fluctuate, and it can be affected by all kinds of things, especially all those companies have been buying back a lot of stock and they keep it on the books as treasury stock. That reduces shareholder equity, which artificially inflates the long-term debt to equity ratio. So I don't really place a lot of importance on that. The number for Starbucks is pretty accurate, because you don't see that shareholder equity being negatively affected so much. But really, the more important number that I like to look at is the interest coverage ratio, which you're basically taking you're taking a look at pre-tax income, which let me find it right here. I'm looking at the income statement. Yeah, right here, earnings before income taxes. You're basically taking EBIT and dividing that by interest expense. You want to know how many times over EBIT covers interest expenses. And when you get that EBIT number, you want to look at earnings before taxes and interest expenses, because it's already been reduced, right? You got that 81.3 right here. That's already come off of the EBIT. So you're taking that 41.98, you're adding back in the 81, so you get 42.79. You're dividing that by the 81. So you're getting an interest coverage ratio of over 50, which I reflect in the article. At Morningstar, I think they have the interest coverage ratio at the bottom. Yeah, they have it right here, 52.64. I came up with 52.82. So I don't know where they come up with a slightly different number there. It's not really a big deal, but they have that interest coverage ratio. And you can see here, right, guys? I was just saying how Starbucks, their balance sheet hasn't really deteriorated. You see it right here. You see their interest coverage ratio year after year up in that 50s. 44, 55, 63, 50. Again, that was an anomaly, and EBIT was negatively affected by that. That's not a real number. 50, 56, 52. Trailing 12 months, they have it at 47. It's not really deteriorated. It's just a pristine balance sheet. When you have an interest coverage ratio over 50, that indicates no problem whatsoever with Starbucks covering its interest expenses, no problem whatsoever with its debt, with managing debt or anything like that. When we start getting into the low single digits, like an interest coverage ratio of 2 or 3 or 4, somewhere in that range, that starts to become problematic. Because if there's any fluctuation in EBIT, if the company starts to slow its growth, or maybe they go in reverse, they go in the wrong direction, they start bumping up against an interest expense, and that starts to create problems with them covering their debt, which can kind of create a snowball there where the lenders become concerned about that, and that starts to affect how fast lenders want to get paid, starts to affect all kinds of things. And sometimes you got to look there, when you take out debt, there's debt covenants and things like that, and you got to be very careful with how close you get to scraping the bottom of the barrel. When you start getting into low single digits, that'd be like you earning, let's say you earn $5,000 a month pre-tax, and your total debt expense every month is $4,000 or something. It leaves very little to cover everything else. You want to be very careful with when you're looking at that EBIT number. Now, again, that's not really totally comparable, because that EBIT number that we're looking at, let me pull it up again. When you're looking at this here, they've already factored a lot into it, but still, when you're getting into low single digits, that can become worrisome. Likewise, Starbucks is well over 50. It's not even something to talk about, other than just to say the balance sheet is pretty pristine. I mean, the only thing that could really be better is if the company didn't have any debt, which wouldn't necessarily be better in this type of environment. They've taken on some very, very modest debt at very low interest rates. They've grown at 18%. You can't really say, oh, well, I wish they would have done this, or maybe they could have took on a little more, a little less debt, and they've managed this almost perfectly. There's really no room to complain about it. And then we talk about profitability at the last point here, which I'm looking at net margin and return on equity averages over the last 5 years, and where I get that number from is the 5-year average here with CFRA. You see the 5-year average net margin at 10.13, return on equity at 35.12%. You see the numbers right here line up. And I've talked about in prior videos, you know, getting these numbers yourself is very easy. Like net margin, for instance, you're basically just taking net profit, dividing it by total revenue. So if you take net income here, let me get that here. Yeah, net income should be right there, 2818 divided by revenue, 21,315. 13.22%, which should be pretty accurate. Yeah, they've got 13.22%. So where I got that, guys, you see the net income down here, right here, net income, and then you got total revenue. You just divide the two. You just divide the net income by revenue and multiply by 100 to get a solid number. So you get 13.22, which is the same as what Morningstar comes up with over the last fiscal year, which is right here, 13.22. But again, as I talked about earlier, you see that expansion, which has been pretty extraordinary. The 5-year average, though, I like to look at the averages because that factors in fluctuations. The problem with this 5-year average, though, is that it includes that significant drop-off right here, where net margin was basically a zero. So this actually is lower than what it should be. This is probably closer to 12% or so over the last 5 years. Same thing with ROE. These numbers are actually higher than they are, or that they're reflected to be, that they're recorded to be, because they had some anomalies there a couple fiscal years ago. Nonetheless, when you pull the picture out even wider and you look at the last 10 years, you see a very, very strong expansion in margins here, net margin. You can probably see that in gross margin, operating margin too. Yeah, you see the gross margin expand here. You see operating margin expanding out. It's an extraordinary story. Will that continue moving forward? I don't know. That will really come from the international growth, as I talked about before. Comp growth, so you got relative growth, absolute growth, and then margin expansion as these developing countries become wealthier and larger, and they buy more coffee and can afford more for their coffee, then that can fuel some of that. But even if Starbucks kind of capped out of here, that's still a very, very good number. And when you pull up Google Finance, they kind of get your related companies and competitors, so you can kind of see what the competition is doing. I don't know if there's really anybody that is there any company out there really that you can say, oh yeah, this company is just like them? You know, they're basically the same thing. I mean, I don't think so. There are some companies they compete with, like Dunkin' Donuts and Tim Hortons, but are they really just like Starbucks in terms of their product breakdown, in terms of the experience, in terms of the product, in terms of the growth potential? I don't really think so. So, you know, even when we could, you know, I've done comparisons before when we talk about like Pepsi and Coke. They're really not the same because Pepsi has a pretty large snack business. It's sometimes hard to compare numbers like this, but just looking at when you have net margins in the double digits, just as a rule of thumb, that's a pretty good number to be looking at, and especially when you see that expansion. Starbucks, if you could take a time machine and go back 10 years ago, Starbucks still would have been a great brand. It still would have been a big business. Everybody would know about Starbucks. Everybody was probably drinking Starbucks daily, and to go from where they were at 10 years ago to where they're at today is again pretty remarkable, and I talk a bit about that. So when we get into the valuation, which is what we're getting into right now, how can Starbucks continue to grow? Let me count the ways. Growing store count, strong comp sales, margin expansion, international development, increasing multi-channel retail offerings and partnerships, which I really didn't even talk about much in this video because there's just so much scale to think about with this business. But you know, you've got the multi-channel retail too, where they license out their products in the retail markets, you know, with the tea and coffee and everything. which is just another opportunity for them to make money. So if you don't want to go to the store, or you don't want that experience and you want that at home, they offer that through the retail channel, which is just, you know, another piece of the pie. But really, the main story for Starbucks is going to be that absolute and relative growth, especially on the international side. And I kind of lay out the case that the only thing that can stop Starbucks moving forward is Starbucks. And what I mean by that is the only thing that can really negatively impact Starbucks is if Starbucks does something wrong. If there's some kind of existential crisis, if, you know, I don't even know what. If we find out that coffee is strongly linked to some type of cancer, if there's a corporate issue, some kind of scandal, malfeasance, something like that, that can impact Starbucks negatively. Is a company going to come out there and come up with something where they can just slay the dragon that is Starbucks? I strongly doubt that. I don't think there's really an obsolescence issue on the technology side. I don't think there's a competitor on the horizon that does it better than Starbucks when we talk about the product and experience. So I believe the only thing I can really stop Starbucks is Starbucks, at least right now, at least on the near-term horizon. I mean, I can't see out 20 years from now, but looking out over the next 3 to 5 years, I really don't. I think their competitive advantages are probably the strongest in that space when you're thinking about consumer products. You know, direct products to consumers like this, food products. I don't think anybody has stronger competitive advantages than Starbucks. And with all that in mind, you would expect the stock to be priced at a premium, and relative to the market it is. The price to earnings ratio when I started putting the numbers together was over 28. It's currently 27. And if we look at the valuation tab, comparing that to the 5-year average, the numbers don't work out right because, like I said, they had some issues there with one fiscal year. So the price to earnings ratio, because GAAP earnings can be affected by a lot of adjustments, that doesn't really make a lot of sense. But you can kind of start to see some other numbers here. Price to book, you know, the book value can also be affected by a lot of things. I don't really place a lot of importance on this. I'm really looking at PE, which again, unfortunately, usually almost in every video and every article I do, there is a comparative number there that we can look at. This time is just one of those unfortunate incidences where we can't. But you can still look at the other numbers, which is price to sales, price to cash flow, and yield. Price to sales, again, if you look at the 5-year average, we're typically looking almost 4 times sales. It's now at 3.6. Cash flow and that's a 3-year average, as Morningstar notes down here, 48.4, which is awfully high. That's getting up there. We're looking at 18.2 right now. And then the yield, as I noted earlier, the average for the last 5 years is 1.3%. Meanwhile, dividend growth hasn't slowed at all. So what investors were looking at, say, 2 years ago, if they were looking at a yield of 1.3% and saying, wow, 25% dividend growth and a 1.3% yield, I'll snatch that up. You're instead today looking at 1.8% or almost 1.9, as we saw earlier, and 25% dividend growth. I mean, is that going to slow moving forward? Was the payout ratio lower a few years ago? Sure, yes, but not that much. And you're getting a spread of almost 60 basis points on the current income. So, you know, are you sacrificing much future dividend growth? Probably not, but you're certainly getting more income for you're getting more bang for your buck today than you would have been on average over the last 5 years. So I talk a little bit about that here, and then we do the dividend discount model analysis, which is the analysis I use. That's the model I use to analyze these stocks when I look at the valuation. And then I compare it to Morningstar and CFRA, which, as I understand it, they use different proprietary valuation methods. So that way you kind of get a really, you know, big picture. It adds depth, it adds perspective, it adds value to the piece. But I personally use a DDM analysis, which I lay out the reasons for in the articles. But looking at Starbucks, because of the very low yield and the very high growth rate, that's one of those stocks where I would use a 2-stage dividend discount model analysis, which accounts for the low yield and high growth rate today, which may change, that dynamic may change moving forward over the next 5 or 10 years as that yield maybe increases slightly, and as yield maybe slows down a little bit. You got to kind of factor that out moving forward. So I've got the 10% discount rate. I use the Money Chimp calculator. I actually use a spreadsheet. I've talked about that in the videos before, but this calculator works the same and it comes up with the same numbers. So we've got the dividend, we've got the annual dividend in $1. And then I lay out the case for the dividend discount model analysis right here. So I've got 10-year dividend growth rate of 14% over the next 10 years. And then I've got that flattening out to a terminal dividend growth rate of 7.5%. We've got a dividend discount. We've got the discount model at 10% calculate. So explaining these numbers a little bit, the CFRA believes that Starbucks is going to grow at 18% over the next 3 years. I'm coming in at a 10-year dividend growth rate of 14, so I'm backing that number down a little bit. So if Starbucks does grow at 18%, they could certainly grow the dividend 18% because the payout ratio wouldn't even expand at that point. If earnings and the dividend are growing at the same rate, then the payout ratio doesn't expand or contract. It stays flat, right? So if Starbucks does grow their underlying earnings per share at 18%, there's no reason why the dividend can't also grow at 18%. In fact, they could grow the dividend a little faster than that and expand that payout ratio just very, very moderately moving forward. The dividend could very well grow at 20% over the next 3, 4, 5, 6 years. And looking over the longer period of time, 5 to 10 years, that could still happen very easily. But I back that down a little bit to err on the side of caution with these numbers, because when you start to really play with these growth rates, if you're coming in too high or too low, that really affects the output. The dividend discount model analysis is very sensitive to the input, and likewise the output can be affected pretty significantly by what you're putting in up here. So I always try to back those numbers down and be pretty conservative with what I think they're going to do over the near term, and then I flatten that out over the long haul to 7.5%, which I think is very realistic. I mean, people sometimes look at these terminal growth rates and say, well, how can a company grow at 6-7%, 100 or 200 or 300 years from now? Well, I'm not concerned about 200 years from now. When I look at this terminal growth rate, in my mind, really, although it technically is a terminal, it is forever, it is infinite when you do the math. First of all, the math becomes a rounding error after so many years. I'd have to look at it again, and I looked into this many years ago when I first started investing, but I forget what it is. After maybe 20 or 30 years, somebody maybe can correct me on that, but after so many decades, even though the number is terminal, even though it's infinite, it becomes a rounding error. So if you take a 7.5% growth rate over 50 years, and you take a 7.5% growth rate over 300 years, the overall output is not going to be changed that much, because it just becomes a rounding error after so many years. So that's the first point. Second point is, a lot of mature companies like a Johnson & Johnson, like a Pepsi, are still growing their dividends at 6, 7, 8%, 40, 50, 60 years into their growth story. So I don't think that's all that unreasonable looking out over the very long haul. And then obviously I use a discount rate of 10%, which I've talked about before. I use that almost always, except for very high yielding stocks. And I get the output of 73.69, which you see reflected here. And then, as I talked about just a moment ago, I compare that to professional analysis firms to see where they come up with, and because again, I think it adds depth, I think it adds value, it adds perspective to these articles, because you're not just taking my word for it. My word for it basically is 1/3 of the pie. And then I'm adding in Morningstar, which is 2/3. You're getting 2/3 of the pie. Then CFRA, which is formerly S&P Capital IQ, that's the last third. So I'm taking those three numbers and averaging them in. So my analysis, my dividend discount model analysis, is not the bottom line number. It's not the final figure. It's just saying, okay, this is where I'm at. This is where these guys are at. This is where these guys are at. Averaging them together, this is a final number. So if someone's really high or someone's really low, and maybe someone's in the middle, you kind of blend those together and come up with a final number where you're taking three different methodologies. You're taking three different people, three different sets of eyeballs, three different looks at it, and you're coming up with a final number and saying, that's probably a pretty good look at this stock in terms of valuation. Keeping in mind that it is an estimate. I'm not saying that Starbucks is worth down to the penny this dollar amount. I'm saying that looking at it the way I look at it, looking at the way Morningstar looks at it, looking at the way CFRA looks at it, this is a bottom line figure. Averaging them out probably gives you a pretty good idea as far as where the stock's at, for valuation. So Morningstar, and I looked at these numbers before I started this video. They've changed them since I started writing it. Again, there is a delay, there is a gap, and you see the date right here. 2nd of August 2017 is when they changed their numbers. They actually noted on July 28th, after the third quarter update, the $70 fair value estimate, they note right here, we see the shares as undervalued but plan to shave $1 or $2 from our $70 fair value estimate as the company works to sharpen its menu innovation and digital engagement playbooks. So they planned on shaving that by $1 or $2, but they actually shaved it by $4. When I wrote this article, that 70 was still valid. That's what they had up top, so that's what I used. I wasn't using 69 or 68 or just guessing. I was using the hard number, what they had. It's since changed, and we'll average that new number in on the video here. I like to kind of go over these numbers again and see if anything changed since I last did the article. But when I wrote the article, that was 70. They obviously changed that just recently, just a few days ago. And CFRA did the same thing. They lowered their number to a little bit. They came out with 48.40. They were at 51.30. And it's interesting that they lowered their number. CFRA, they're kind of funny a little bit. They're kind of interesting because I'll sometimes pull up a research report by them, and then like the next day it'll be different, or you know, a week from there it'll be up or down, or you know, they seem to change their numbers pretty often, whereas Morningstar is almost it's pretty much just once a quarter with Morningstar, unless something major comes out in between the quarters. Just once a quarter, they look at their numbers, review, they account for the time value of money, which I think is pretty relevant. That's germane to the valuation. And then if anything happened in the quarter, they may impact it a little bit. They shaved it by 4. That's a pretty large adjustment, I think. But I think really, if anything, Starbucks is stronger than it was before because of that international development. So that's good stuff. Nonetheless, even though CFRA believes that the growth rate isn't going to slow, I don't know why they didn't maybe kind of reflect that here. Change that to maybe 17 or 16% if they're going to say the company's worth less, but it's going to grow just as fast. You know, they're kind of funny with their numbers. Nonetheless, they did drop that down a little bit to 48.40. So we'll average these out, guys. See what it came up with. So we got 48.40. We've got 66. And on this particular one, I'm the highest, but I'm not always the highest. I'm often the lowest. It just depends on the stock. It depends on what I think is happening here. This particular one, I am the highest. It really just depends on the article. It depends on the stock. We divide those out. So we get a final valuation of 62.70. So it's a little lower than the 65 I came up with at the time of the article. So if we take that 62.70, where's the stock currently at? 53.74. So the stock looks about 17% undervalued. So it's roughly about the same. So what happened was the stock fell a little bit since I wrote the article, and the valuation also fell, but they fell in kind. And plus I round. So I rounded up, and I might have rounded down, so that also might account for, that could account for almost a full percentage point, almost. And then when you adjust for the stock at the time of the writing compared to where it's at now, that also affects it. So yeah, you can see right here, guys, the stock is 53.74. When this article was published, it was a 55.44. So it changes a little bit. And again, when I write these articles, keep in mind, I'm not saying that Starbucks is going to zoom up by $3 or $4 next week or something like that. I'm saying that over the course of many years, it's going to be a very good long-term investment. And relative to its intrinsic value today, I think it's about 17% undervalued. When that gap will close, though, is it going to close tomorrow? Is it going to close a week from now, 2 weeks, or 3 weeks from now? No, I don't think that. Will it close over the next 6 to 12 months? Possibly so, probably so, especially if that valuation rings true. But again, you always want to have that margin of safety. You always want to have that kind of buffer in there just in case the thesis is wrong, in case something's not right, in case the company does something wrong, your thesis is incorrect. There's any number of things that can affect that. So the larger this number, the better, because just in case you are wrong on it. Let's say Starbucks is only 5% undervalued right now. Well, you're still getting a pretty good, I mean, unless Starbucks is overvalued, which that would have to be a very large swing in the opposite direction, you're probably getting a good long-term investment here. Again, assuming, as I spoke about earlier, you are a younger investor, you do have time to let that investment kind of bake, let that compounding work on your behalf, and let that dividend income grow to the point where the aggregate income is strong and the ongoing income at that date down the road is pretty substantial relative to the investment size, which would not be right now. It would have to be 10, 20, 30 years down the road. And as a long-term investor, that's really what you should be thinking about. You shouldn't be thinking about, well, what's Starbucks going to be doing 6 months from now? What are they going to be doing a year from now? What are they going to be doing 2, 3 years from now? You should be thinking about, what is Starbucks going to be doing 10 years from now, 20 years from now, 30 years from now? That's always the mindset you should have when you go into an investment. And I can tell you what they've done over the last 10 years. The stock is up 300% plus growing dividends. Is that going to repeat itself in the next 10 years? Probably not. It also depends on the valuation at the time of buying it. And back then when the stock was split adjusted $5, that was an incredible value, and that's at the time they were having some issues, and I can't remember the year that Schultz came back on board, but they were having some issues back then. And gosh, I wish when I first started investing back in mid 2010 or so, the stock was what, $12 split adjusted. I wish I wish I would have bought Starbucks back then, but the yield, we can scroll down here, the yield was what, 2%? Yeah, somewhere in that range. You see right here, quarterly dividend 0.4, so 1.6% or so. Early 2010 when I would have been looking at it, 1.6. It just wasn't enough to get the dial moving for me. I needed that dividend income to start rolling in immediately. I needed to start compounding things right away, because although I am young and although I'm only 35 and I'm thinking about the Jason of 45, of 55 years old, 65, at the same time, I wanted to aggressively move along that dividend income so that I could quit my job and become financially independent and work on things I wanted to work on, when I wanted to work on them, with whom I wanted to work on them with. I wanted to become financially free as soon as possible. So I'm a 35-year-old going on 65 years old, if you know what I mean. I'm like an old 35-year-old because I wanted to retire at a very young age. That all said, I do still in my mind think about inflation, think about purchasing power, and think about income growth for many, many years down the road, because the last thing I want to do is become financially independent at 35 and then have to go back to work at 40 because I couldn't make things work. So you always gotta want to have that ace in the hole, if you know what I mean. So there's the bottom line, the bottom of the article. It's one of the best businesses in the world, undoubtedly one of the best businesses in the world. I mean, Starbucks is right up there with an Apple, with a Nike, with any other fantastic business you could think of, any other brand that you could think of. They're right up there with all of them. And with the valuation, I mean, you could argue with this undervaluation and say, you know, I think Starbucks is only 10% undervalued or 5% undervalued, but I really think you'd have a hard time looking at some of these some of these historical metrics compared to where they're at now, and look at, you know, the China story and say, oh, Starbucks is overvalued. I just think that would be a hard case to make. And sure, you could say that PE ratio at 27 times higher than the market is up there, but is Starbucks not a premium business to the S&P 500 average? I think they are. I think they're one of the best. I mean, if I had to name 10 of the best businesses in the world, I think Starbucks would probably be in that category. And the S&P 500 is about 500 companies. Are they in that top tier? Absolutely. Should they not deserve a premium valuation? Absolutely. And keep in mind too that the PE ratio does not exist in a vacuum. It's relative to the market, sure, it's relative to the industry, sure, but it's also relative to the growth of the company. I mean, a PE ratio of 27, 28 times on a company that's growing at 18% is not that. I mean, if you're looking at the PEG, the price to earnings growth rate ratio, that is very, very strong. I mean, that's very, very appealing. Likewise, if you have a PE ratio of 12 on a company growing at 1%, that's not great. You know, that's not great. That's a PEG ratio of what, 12? I mean, if they're growing at 1%, they got a PE ratio of 12. That's a PEG of 12, and you got the PEG ratio right down here at 1.6. So, I think it's pretty good. I mean, I think the valuation is there. You could argue with it if you want, but to say Starbucks is overvalued here, that would be a very tough case to make. I think if anything, it is definitely undervalued here. By how much? Again, you can put your own numbers on it. I came in the most aggressive, keeping in mind that these numbers were higher when I did the article, even with reflecting the new numbers. The only number that really comes in quite low is CFRA. I am not that much higher than Morningstar. Morningstar and I are kind of on the same page. CFRA is way down there, so they're bearish as I reflect in the article. But overall, the valuation looks pretty appealing when you look at the yield, when you look at relative valuation, when you look at relative growth, when you look at the outstanding opportunities in both relative and absolute growth within their store count and the comps. It's a wonderful business. So hope this video provided some additional perspective. I hope it complemented the article well. I'm always happy to do these. These are a lot of fun for me. As you could probably tell, I do these videos almost always in one shot, unless there's something maybe something changed between the time I wrote the article and the time I do the video, and I have to pause for a sec to take a look at what happened. I generally do these videos in one shot, and you know they're usually around an hour or so. So I could do this stuff all day. I love talking about stocks. I love talking about businesses. This stuff is exciting for me. For other people, it's watching paint dry. But for me, it's exciting. I love thinking about what this company can do and how owning shares in a great business like this can positively impact your life. It can change your life. It can make you free. It can make you independent. It can open up a whole world of opportunities for you. And like I laid out in the beginning of this video and in the beginning of the article, each moment is an opportunity. And when you think about every single day and how many opportunities there are within one day, and just add that up, a week, a month, a year of your life, how many opportunities you might be missing, and you got to think about that. So I hope this video served you guys well. Hope you enjoyed it. Hope you stuck with me. If you guys ever have any questions or anything, shoot them over. You can either shoot them over to Daily Trade Alert or contact me through the site. I'm happy to answer them. Appreciate it, guys. Have a wonderful night. Thanks so much. Bye-bye.